Gold Resurgence in a VUCA world. Welcome to the Foundation for the Study of Cycles FSC vlog, March 27th, 2024. Key insights: cross-asset mixed signal in terms of a late stage cycle dispersion as we drift into Q2 of this year, where some cycles are starting to suggest short-term downside risk. This is part of a big picture behavioral inflection point which remains ahead since December of last year, 2023, into January, February, March, and April ahead. All-time highs on gold, which is our primary focus in this FSC vlog, and Bitcoin, which is part of the cross-asset mixed signal, but also an opportunity for us to look at each asset class individually and together. A quick word about an index called BOLD, where you can do that in a smart, diversified way. And then back to gold, major breakout targets 2,700, but short-term overbought. Keep your eye on latest price action and the FSC cycle model, which does suggest that we get a two-stage move, marginally higher, then down, and potentially further upside in the second half of this year. And then as a grand finale chart, I want to give you a quick update on equity markets as part of this risk on, risk off rotation, risk on all this time. And the key point there is party like it's 1999, that old tune, until the music stops. Big question, when is that stoppage time coming in? So this is what to look forward to for the session today. Do know there is a further information in a media interview on IG, Where Does Gold Go? And of course, the brief overview to this vlog on our cycles website. Cross-asset mixed signal, late cycle dispersion, rotation. Looking at the trend ranking model, which also includes cycle timing, we're looking at strategic, tactical, active, long-term, medium-term, short-term. And what I've done is highlight top and bottom movers and shakers. At the top, we see a blend of both Bitcoin and gold in terms of two record-breaking commodity and digital asset classes. Japan at multi-decade record highs. So in the equity complex as part of a non-diversified international look at markets. And then, of course, everything else in and around that, USA in blue, strong but unwinding. Then we have markets like China, which are super oversold and unwinding from that extreme tactical area. And then other markets that may be of interest. Now let's try and add some context to why markets might be risk on with some late stage dispersion in what could be a mini shakeout risk ahead. It's part of this behavioral inflection point, which I've been speaking about both with the FSC and also in my own advisory work, focusing on the sentiment crowd psychology, but also some of the cyclical framework around that. One of the new charts that I want to introduce you to is expectations for recession, and this is soft landing, so i.e. the Goldilocks scenario where things are going to be good, happy days ahead, nothing to see here. We've hit an historic extreme not seen ever before, over and above the prior peak areas when the crowd got it wrong in 1999, going into the tech bubble burst and crash, and 2008 global financial crisis. Now, what's interesting are a few points. One, crowd wisdom could be wrong at record extremes. Two, this is the third time and potential strikeout signal to build on the baseball analogy. And three, the last time we got it wrong, i.e., last year, there was a prediction for 100% probability of recession. Many of the world's smartest people also echoing that risk scenario. And in the end, when it proved out wrong, global economy was stronger than expected, and ultimately there was a so-called central bank policy pivot, which we're still waiting for in terms of potential Federal Reserve rate cuts. uh, we flipped from bearish to bullish, and perhaps too much. We became too optimistic in terms of economic robustness, market valuations, and also uh, central bank policy without really factoring in enough risk for a policy mistake and recession itself. That's the analogy that I want to share with you from a behavioral and cycle point of view, because keep in mind, uh, people drive markets, and that ebb and flow of crowd psychology is what creates the cycle, and particularly when we're at extremes and due a potential inflection point. Now, the underlying driver here is also inflation expectations. So I want to just bring you back to uh, a chart insight shared previously of this historical analog of the 1970s, where we had rolling waves of inflation. Uh, quick disclaimer point: history doesn't repeat, but it does and can rhyme, and we're looking for the variation of that rhyme, not a one for one. This is a model, not reality, but so far so good. It's matching up pretty well, and you can see there I've overlaid the scale of the 1970s with the scale of here and now. And you can see that we're right in that juncture, 6 to 12 months of a resurgence in inflation after we've already halved inflation, headline CPI in the US. Now we're getting this potential sticky inflation that is coming up in terms of month on month headline reports, suggesting that we may uh, have higher for longer ahead. And of course, we then have some market tail risks, which have yet to be factored in, like geopolitics, which I've just highlighted there. Also, an insight expectation from one of our guest experts that will be interviewed soon as part of the FSC Masters Working Group. I'll be following up with details. His expectation is for a geopolitical risk or a potential market crash this year or next. That's an outlier view, but still one that is gathering steam by some experts out there. Keep in mind, the long-term inflation's resurgence also accelerates into 2026 and is lined with the 18.6-year cycle timing, uh, which is also identified elsewhere in FSC research. Now, this would be a two-stage move as part of a rolling wave cyclicality, where we likely get a resurgence to come, potential deflation uh, unwind, and then further inflation before another deflation unwind. So this isn't a straight line up and down. This will be a zigzag affair, which will ultimately lead to asset price deflation in a potential market crash scenario, as and when that becomes due. The recommendation, when we get some meaningful rotation into a more inflationary environment, is commodities, especially oil and gold, and big focus on gold in this session, both exhibiting spike risks as well in terms of how those markets can move, particularly when there's more uncertainty and inflation risk. Swiss franc, for those of you who are looking for currency, safe haven. These can be historically reliable diversifiers. So if you're looking for tangible, actionable markets to position in, have a think about both commodities and the currency that has just been highlighted. Now, remember this crisis alpha wildcard? I shared this uh, thematic and timely survey from Goldman Sachs from their client base, highlighting that more than half are concerned about geopolitics. And there's a whole range of reasons for this, not least the broadening, prolonged tensions and whether it be Ukraine, Russia, Israel, Gaza, and recently the Taiwan elections, which had triggered concern in terms of US and China relations. But just recently, we had the Russia elections passed and a terrorist bombing in the area. Essentially, this is part of part of a transition from a uni-global to multi-global world, deglobalization, as well as just general inflationary pressures, which tend to ignite social mood and lead to more polarization. That is geopolitically charged by itself, but we can actually see this in the headlines and when we look out of our windows and see how that ongoing change and disruption is continuing. Keep in mind, we also have record double-digit elections this year. So I've just mentioned a few: Taiwan, Russia, and more to follow. The most important being US elections coming up in November, which could be an event risk, tying in with both the market and cycle views that both myself and FSC board members have shared. Now, just to quickly round up, the other concerns on this survey are naturally US elections, just mentioned, inflation and recession. But just keep in mind that this can be a cascade effect. All you need is one of these triggers to occur, and the rest can follow. Let's now fast forward to record highs on gold primarily, but also Bitcoin. These record all-time highs for Bitcoin and gold realign their behavioral patterns and coincide with our short-term tactical cycle for both March and April. However, in macro terms, the twin peaks offer mixed signals of both defensive and speculative investor sentiment. So that's where there is a little bit more of a variation. Either way, the unified trading strategy is chasing short-term momentum, which is now overbought. Just as a side point, the long-term accumulation pattern on gold is known as the cup and handle pattern, originally developed by veteran technician William O'Neill decades ago. And that suggests a move up to 2,400 and 2,700. And then you can also see a more compressed but faster and bigger accumulation pattern on Bitcoin, given that it's a different type of volatility signature, which both, whether you're looking at gold or Bitcoin, project ongoing record highs ahead. Now, the recommended guidance from a portfolio point of view is to trade one or the other, or in this case, both. Looking at Bitcoin and gold, the advantages there is when they're both doing well and at record highs, you outperform, it's a double win. But at the same time, we know nothing goes up in a straight line forever, and markets tend to zigzag or cycle. If they do, and for example, gold goes sideways, or Bitcoin and crypto has another winter, or just extreme volatility in this risk on, risk off market regime, having a diversified positioning in an index such as this one, called Bold, B for Bitcoin and the rest for gold, allows a rebalancing according to an inverse historic volatility, and is, let's say, a good way to enhance performance but also manage risk when necessary. This is developed by industry colleague Charlie Morris, CIO at ByteTree.com, and it's just an additional overlay to consider when looking at both of these markets, especially now they're at record highs. Now, on that headline view, gold breakout targets 2,700, although here and now short-term overbought. This is the move that we're seeing right now, which is a break above that 2,000 glass ceiling. That already is a big milestone move, and the fact that we held above 2,000 and continued higher in such a strong way year to date 2024 speaks for itself. But also keep in mind that the acceleration has happened before. We've had this impulsive shock pattern twice last year. Remember, a big part of understanding cycles is in studying the behavior of markets, both in price and time, particularly if and when those moves or events happen again. Previously, these were event risk occurrences, bank panic of spring last year, and which is more of a kind of a credit event, and then next to it, a geopolitical, the Israeli Hamas war. Either way, any kind of uncertainty, whether it be markets or geopolitical, gold tends to have that shock impulse, which is what we saw twice last year, and we're continuing to have it again now. What's interesting, if you look at the top right-hand chart, it's not just gold in dollar terms, it's also gold in world currencies. And looking across gold in 6 fiat currencies, gold is at all-time highs. And that is telling you this is a debasement story, i.e. the money in your pocket is losing value day by day. And so hard assets become more valuable than soft paper assets. And for that reason, we get a rotation between the two. Last point on the subject of risk and geopolitical risk, keep in mind that gold can spike. And this is something I've shared with FSC members before. Beware of the crisis spike of 1980, 1973, bottom right-hand chart, figure 3, where gold can not just spike, but spike by $700 in just a few weeks. Previous to that was 1973-74. That's the historical analog of here and now, 40 years on. Either way, it's the upside surge in uncertainty, which often spikes. That's something that we should at least keep in the back of our mind as a potential scenario ahead. Now, what's interesting, looking at the FSC cycle model, which is based on spectral analysis, and just so you know, the type of cycle work I do is multiple, diversified, and where possible, I try to triangulate. Sometimes there are leads, lags, or divergences, but often it's the triangulation which gives you that stronger probability signal. Now, here and now, looking at the FSC cycle model, we can see there's a 2-stage pattern prediction where the market continues higher in the short term, but likely unwinds into Q2. That's April onwards into May, as part of a unwind to the momentum trade. I wouldn't think of this so much as a risk-off mode, which should be bullish gold. I would just think of this as the gold market unwinding significant gains to the upside. Although, from a macro perspective, this may well be a risk unwind environment, according to the work that I've been doing and the cycles that align with that. So just look at your FSC cycle model on gold and continue to track it stage by stage to see how that plays out. And then just finally, the grand finale chart, Party Like It's 1999, building on that well-known song from that period. But until the music stops, and big question, when will that happen? What is stoppage time? This is a big feature chart that I've been sharing and raising awareness on. It's the NASDAQ back in 99 compared to now. Another analog to keep in mind. Remember, history rhymes, not necessarily repeats, and the variation of that pattern rhyme, both price and time, are matching up right here and now. You can see the blue line is NASDAQ 99, yellow is here and now, and it factors in a further upside marginal melt up of up to 10% or so. That would actually match the pattern, but it's within the music stoppage time of a peak in progress. And I'm just going to quickly annotate this for better focus. You can just see me highlighting the peak 1 there, where we could still head higher, but it is a market fragility moment, which could lead to a 3-stage corrective pattern. Now, the cyclical model that I use, based on the roadmap model developed by a mentor, Robin Griffiths, is based on 3 stages: a fall, oversold rally, and then rest of fall. That is typically how markets behave in a late stage corrective pattern. What's interesting about that is we don't get an all-time high. That may or may not happen. We have to wait and see. But after getting a big fall, we get that oversold rally, which is part of a consolidation reaction, all the way into the September and October negative seasonality period, and then further downside into November, US elections. That could be a plausible scenario here and now. What's interesting is the magazine cover indicator, a crowd psychology um, contrarian measure, has just signaled to mainstream press themes, one in The Economist and second in Barron's, just showing just how elated and irrational the market is. If you look at the top right-hand chart, figure 2, this is part of the momentum trade, which is as strong as it was in 99, but every acceleration becomes unsustainable and leads to a momentum unwind or crash. So that mean reversion risk remains. And if you look at the FSC timing model, just in the bottom right-hand corner, figure 3, the price and time divergence remains. That could be a false signal, time will tell. But keep in mind that the longer that divergence holds, if and when it realigns, the harder the reaction that will likely follow. Side point here, this is not a price projection, it's a time pattern probability, and that shows Q2 going into June as being a likely volatile period. And I'm just going to end on some S&P 500 timing insights for some of you that are quite keen to learn more, especially as we go into the eye of this potential stormy cycle ahead. The S&P 500 behavioral inflection point based on short-term tactical natural cycles continue to suggest the period of late March going into April. We also have a double eclipse coming up, which can lead to inflection points, particularly if the market's overbought. The price channel that I've highlighted there on the left is at 51.90. And then, of course, roundophobia 5,000. If we break back below 5,000, that will suggest a important reversal point. And keep in mind this three-stage pattern fall, rally, rest of fall from late March going into April, and ultimately the sell in May negative seasonality to follow into then June. The base case scenario is at the very least a 10% correction, which would be healthy. That's the bottom of this channel from October 2022. So keep that channel on your radar screen so that you can at least map out the potential reversal from all-time highs, but also the price projection likelihood ahead. And then for those of you that like to use more advanced and specialized techniques, this is based on WD GAN, a request from one of our FSC master working group members that also practices the technique. It's squaring price with time and producing a mathematical grid, which allows you to triangulate particular inflection points in the market. And it shows a vibration pattern anchored from 2008, global financial crisis, marking key inflection points. The latest all-time high hits key resistance at 51.50. The time projection signaled into early Q2 April with the double eclipse just mentioned, one past lunar eclipse 25th of March, and the one ahead 8th of April to watch for. Factor in a plus or minus one standard deviation to see how the market may react in and around that band. That's it from myself, Ron William. Gold resurgence in a VUCA world, cross-asset mixed signal, behavioral inflection points remain, all-time record highs on gold, the primary focus of our session today, and Bitcoin as a side point for those of you who are big fans of either or both. Remember the index bold if you want to diversify and enhance performance. The major breakout for gold is still up to 2,400 and 2,700, but it is short-term overbought and likely to unwind, particularly if you look at the FSC cycle model that continues to signal a two-stage pattern up now and then down during Q2. And then, of course, the grand finale chart just shared, party like it's 1999 until the music stops, and we may currently be in that stoppage time into Q2. Thank you very much. Big thank you for everyone that's following the work and all that we share here at the FSC. If you would like to follow up with any questions, email ron.william@cycles.org or reach out to me on social. Wish you all the best and look forward to checking in the following month. Take care.